Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. Thank you so much for joining us. So this is episode 100. So we started this podcast last October. We're now here on episode 100. It's been quite the journey and very rewarding for me in ways that I never anticipated. I think that people have, really enjoyed it. It's become more than I ever thought it could be. And so I thought, we've got to commemorate, doing 100 of these things. It's a lot of effort. There's a lot of people behind the scenes that make this show a reality. I'm just a talent. I show up and talk, which, happen to be okay at doing that part of it. But we've got my producer, Brittany Hobson. We have Victor Peru, who handles all the post-production, and we have Ted Zahn, who helps us write a lot of the show notes and those sorts of things. So I'm thankful for all those people, but I'm also thankful for today's guest, Mark Hanf with Pacific Private Money. And there's a reason why we had him on for episode 100. Mark happens to be the fellow that I had met down at the Commercial Mortgage Association, also known as CMA, back in 2012 or 2013. And right after Matt and I had decided to pivot our business at Fairway America. And really, Mark was one of our first, I think he was technically the third fund advisory consulting client. So he engaged us to help him navigate moving from sort of a fractionalized or whole loan model to adding a blind pool fund, where he could pool the mortgages and have investors invest. And he was technically and officially client number one for our fund administration practice. So I've been working with him and his team for a really long time, and we continue to work with them at Verivest to this day as a client of ours. They are also Verivest Verified Gold members. So, this is a group of people who have been with us the whole way and committed to really everything we're doing and a part of what we do and what we believe in at, Verivest and Fairway America. So really excited to have you on, Mark. Thanks so much for your time today.
I am honored to be on episode 100. I didn't realize it until you just let me know that earlier before we got on. So great to be here, Lance.
Yeah, no, we wanted to surprise you. So happy to have you on and talk about these things. So, not sure if you want to expound upon that, but I think, from Mark's perspective, right, being able to watch him really build and grow his business, and I think it really points to Mark as the type of guy who's very committed to doing things the right way and doing it right the first time. He values, other people who, know more about certain things than he does. He's willing to kind of admit those things. I think it speaks to a lot of your success. So maybe we can kind of start there, Mark, how you got into this business of, the private lending industry and you have a long storied, career in real estate, but before you decided to move into lending side. So maybe just share a little bit with us about, how you kind of got to the point that you decided to launch Pacific Private Money. I guess it was back, 2008 or something? Maybe.
Yeah. So my background, thanks, Lance. I appreciate that. So I started Pacific Private Money in 2008, and I've been in actually the real estate industry for 40 years now. My dad was a developer. I came up through real estate development. And an interesting thing happened in 2007 and 8, with the real estate market crash. Our company, like many other small family-owned development companies, didn't survive the turn in the market. And as through fate, I met someone who was doing hard money lending, and I learned that business model and realized that was a perfect way for me to pivot, because it took very little money to launch that business. Trying to go back to be a real estate developer back then with no money was a little bit difficult. Yeah. So I launched in 2008 and started out of my home office. Then in 2010, got an office, hired my first employee, and then right around 2012. I got introduced by watching, a video of another company that had launched, a syndication, a mortgage pool fund. And So I spent a lot of 2012 trying to figure out how to do that because I didn't know what I didn't know.
Yeah.
And then I remember very clearly meeting you at that CMA meeting in the fall of 2012 and striking up a conversation with you. I think you were sitting, working on your laptop in the corner of the room there. And I just randomly decided to go up and introduce myself to you, and which again proves to me that you're only one relationship away from an explosion in your business. And I've been tried to be an avid networker and collaborator in my career, and it's proven to be very, very fruitful and serendipitous. And of course, meeting you and having that conversation was incredibly serendipitous, because when you told me what you and Matt were doing, I realized you're exactly the guys I was looking for. And that was the start of what's turned out to be now 6 syndications that we've launched, the first several with your direct help, which has been great. And I really, as a sponsor and someone who learned quickly how to originate loans and how to work with individual trustee investors, as we scaled, it became obvious that working with individual investors, while I liked them, it was a little bit like cat herding. It's hard to scale. It's very inefficient. So I think a lot of us in this business, as we grow, we realize that having a captured pool of funds is really the way to go. And I just didn't really understand a lot of the ins and outs of it. Like, how do you treat the waterfall, which is, how the monies are distributed? What do you pay your investors? What are best practices for running a fund? These are all the things that you and Lance helped me with, and it's been very successful. I mean, today we're managing among our 4 active funds. We're about to break 100 million in private capital across 4 funds. So it's really the way to go. And it's never been easier today for companies like ours to raise capital in the private markets. But certainly if you're a private investor out there and you're investigating opportunities to invest in for higher yields, there's also never been more choices and a greater need for caution and information and transparency in this business.
Yeah, no, there's no question about that. Yeah. And I think, when you look at the opportunity that you guys have really seized over the years, right, is really that it sprung out of that global financial crisis, right? The banks,
absolutely,
they took a beating, which they probably deserved. But it also caused them to really pull the reins in on their own lending activity, right? And so when you really look at, it really just narrowed it down to just really conventional. It had to be in the box, which allowed, and they really got out a lot of the other lending types. And so, and then of course, the product that really hit the market then was all of this distressed single family real estate, right? That was just sort of abandoned and, and that brought in and ushered in, which was always there, but just the notion of the fix and flip or the rehab, right? And so then to get access to financing to reposition a property and put it back on the market and, and sell it, is really where I think that lending activity took off. But really since then, when you look at this unbundling of banking as we know it, banks rely, these days on, fees generated from overdrafts and, all sorts of other silly things is sort of how they make their money. But it really, this void was created in the market and which the private sector has filled, and firms like yourself have jumped in. And so, we said it before the show, right? Before, back in the day, we called it hard money. It's also known as like lender of last resort. And I think that the reason why that existed, why people were parked there, was because the banks did sort of go all the way. They went a lot further, right? They would do construction lending, and they would do, they did. It's not to say they don't today, but it's different, way different. They pulled way back on that. And so really to be in private lending, hard money loans, meaning, well, we're going to assess this opportunity solely on the real estate. And really, we hope you default because we wouldn't mind having this real estate, right? It's like, you've got no other choice, lender of last resort. So maybe you can just give us a trip down memory lane as to what those gaps are, right? Like, and the things that I think you've done for you guys. You offer many different loan types now, many different borrowers. It's not just rehab loans. There's quite a few different borrower types that you guys work with. So maybe just kind of give us a rundown on what those are.
Sure. So at Pacific Private Money, we are in the lending business. And I know you work with a lot of syndicators and interview a lot of syndicators. And I just want to make it clear that our funds and our business model is we're a lender. We're in the alternative lending space is how I like to call it.
Yeah.
That's kind of grown from hard money, which became private money. And now we're really alternative real estate finance providers. And in fact, in addition to the traditional private fix and flip and ground up construction and other types of products, we actually just added a new non-QM lending division to our group this year, and that's starting to take off. So we're really taking advantage of how alternative to bank and conventional lender financing has really exploded. I mean, it's really the fastest growing segment of mortgage lending is the alternative space, including non-QM, but even just in what was purely the private side, which is fix and flip, ground up construction, even consumer bridge loans, which is a relatively new product that we've been doing now for 5 years. And in fact, that's one of our fastest growing products. All of those loan products are the growth is amazing. I know our growth. In fact, last year we actually we had another growth year in 2020. We did 175 million in loans in 2020. That was up over 150 in 2019, and we're on pace for 250 million now this year. So we've really grown and scaled. And our 4 syndications, our 4 different pooled funds do focus on 4 different areas of mortgage products. So for example, the fund that we launched with you originally back in 2013 is kind of a traditional private money fund. It has a mix of fix and flip, small balance commercial, some consumer bridge, owner occupied bridge, and a little bit of ground up construction in there as well. But then we launched a fund focused solely on ground up construction. We launched a fund focused solely on investing in seller carryback notes, which is one we're pretty excited about. We launched that about a year ago. And then a fourth one rather, that is relatively unique. And we're really excited about this. We launched a fund where we pay a fixed rate of return to rent capital from some of our higher net worth investors who don't want to lock up their money. And so we've got a fund syndication where even though by law it's still is in the private placement memorandum, it does talk about having a 12-month commitment for keeping your funds in. We don't enforce the lockup on there, so people are able to, if they need the money, they can take it out. We don't charge them a penalty on that. But that one we use for our own internal purposes, like a warehouse credit line. We close loans that we're going to sell, and that's another nuance of the alternative finance industry, is that in the past we were portfolio lenders. Either on behalf of our investors, our trusted investors who were investing in those notes and they were holding them and we were servicing them, or initially our fund model was our fund is going to hold the portfolio of loans. And now we've got a fund that, which I just described, where we're raising capital for the sole purpose of funding and closing loans that we intend to sell to institutional investors. Because now the institutional market has learned that with the right credit guidelines, the so-called buy box that they solve for, we can, by increasing the level of credit of these loans and the requirements and the information that we gather, it's no longer, the hard money loan where you could literally write a note and deed of trust on the back of a napkin because you're secured by the asset. Nowadays, the quality of the borrowers that we're seeing is so high. Average FICO scores above 720, mostly a short-term need. They're really just renting the money for a short-term purpose. So, that makes this particular type of note investment so much. I don't like to use the word safe, but let's just say it's safer than the traditional hard money loans. Most people rent our money for a short period of time now, and that's good for the investor because it lessens your exposure to real estate risk. If you know that your money is largely being used to fund loans that are going to be paid back via conventional financing or resale within a year, you can pretty much have a high degree of confidence that, the risk is highly manageable, because we know that real estate markets, while they do cycle, they don't cycle quickly. And I love to remind people how the so-called real estate market crash of 2008 really wasn't a crash. It was a prolonged downturn over a 3-year period, which we had never seen before in our lifetimes. And so even then, we were making loans that in short-term in nature that were paid back. And in fact, our continued claim to fame after 13 years is we've never lost a single dollar of investor capital or principal on any of our loans.
Yeah, which is impressive. And obviously we've been, it's been this crazy run, and it's but plenty of people I've worked with that still have made loans where they over advanced and borrower couldn't execute the business plan, and net you take a haircut on the loan, right? And so it's it happens. And I think that's what I always try to remind investors of, is just that not all private money lenders are created equal. Not all private money loans or debt fund, all those things, like there's nuance to it, right? And I think that you've got to suss it out, and you've got to understand who you're working with. What is their acquisition strategy? How do they source opportunities, loans, deals? What is their underwriting criteria? How do they go about, understanding, how they do that? And as you guys know, I mean, originating that many loans is that it's very, very process driven. I mean, like, you have to have a process. You have to have, right there, those things have to be in place. And that's where I think a lot of guys get in trouble, is that they don't have a good process.
Yeah.
And
well, we've stopped originating the type of loans that we were originating 10 years ago.
Right.
And even 5 years ago, we were green lighting loans that we wouldn't green light today, because you're right. As the alternative lending space has grown, those like us who have chosen to scale, we've really, I don't want to say forced, but we've moved in a different direction to serve a different market, a higher quality of borrower, a really focusing on the short-term need rather than a long-term need. So we're looking for distressed transactions, not distressed borrowers. So whereas 20 years ago, hard money was the lender of last resort to distressed borrowers with credit or income challenges, but they had real estate they were willing to encumber. Today, it's the transaction that's in distress. It fell out of bank financing. They're trying to compete with cash buyers to make a low or no contingent offer on a purchase. They need to close quickly for one of many different reasons, or there's just something about the deal. Divorce is very common in California, where one of the divorcing parties wants to buy another home. Well, the bank says, call us when you've got your divorce final. So there's just a lot of situations where the borrowers are making good money, they've got good credit, and they need our money, because bank financing, for the reasons you talked about earlier, they've pulled back. Dodd-Frank made it much more difficult for banks and conventional lenders to accommodate many types of borrowers, particularly self-employed. So a lot of, probably half our borrowers have some kind of self-employment or business income aspect to it, which again is also difficult for banks to process. I mean, take myself as an example. The last 2 homes that I purchased, I used private capital, my own investors, to fund the purchase loan for me, because it takes me anywhere from 90 to 120 days, because of my complicated tax returns, to get bank financing. That's how long my I've got a conventional 3% conventional loan with Wells Fargo, which I love, but it took 120 days to close. So it's easier to refinance for many people in our economy today than it is to get a purchase money loan. So we really do a lot more purchase money loans than anything else. We don't do a lot of refinances or cash out refinances on real estate, which I think is a riskier loan type. It's really, the demand for purchase money for fast and easy funding is really the marketplace we serve. And as a result, we're able to get, tax returns and credit reports and certain types of, credit guidelines that we didn't solve for before. And as a result, institutional buyers really, really like that debt. They get a higher yield. Yes, it's short term, but they can continue to invest over and over again in those types of loan products and achieve, yields for themselves, in the 5, 6, 7% range that they wouldn't see elsewhere in the marketplace.
Yeah, exactly. And is that what you sort of, it's when you call it consumer bridge, that's sort of what that's the bridge is, just it's purchase money financing for owner occupied.
Yes.
Yeah. Okay.
Yeah, that's not a lot of lenders are in that space. And the reason for it is largely because you have to have additional licensing, the NMLS licensing that a lot of real estate professionals are familiar with. And the software and the manpower to be TRID compliant and all those other boring things that a lot of investors listening are probably not familiar with. But the bottom line is there's a lot of people who, if they knew they could borrow or rent money for a short period of time to be able to make an aggressive offer to buy their next home and move right into it without having to sell their existing home first, because we could tap the equity in their existing home, would that be something that, they'd have an interest in? And it turns out, a lot of realtors and mortgage brokers are selling that product on our behalf to their clients who didn't realize it was even a thing, because it's a relatively new product in the marketplace right now.
Yeah, because when did you guys start doing that? Was it like 3 years ago or when?
Well, actually, it wasn't too long after Dodd-Frank when we worked with our law firm to get the proper underwriting guidelines to be Dodd-Frank compliant. So it's been about 5 years now. We've done over, I think, 500 loans of this nature to date that are, purchase money for a consumer buying a primary residence. And again, why I keep saying, consumer and primary residence is that most people in our space, in the private lending, alternative lending space, they won't do a consumer purpose loan. They're not licensed to do a purchase loan for a primary residence. They may lend you money against your primary residence if it's for a business purpose, but not for the purpose of purchasing the home that you intend to make your primary residence. And so we do that specific loan. And that's, in fact, that's our fastest growing loan product. In the last 2 quarters, over half of our loan origination volume was for this particular consumer purchase money bridge loan product. Given where we are in the marketplace today, it's probably not too surprising that people trying to compete today to buy a home, you got to be aggressive. And if you don't have all cash, using a bridge loan is the next best thing because it acts like a cash offer for buyers. So we're pretty excited about that product.
Yeah, no, and that's what I think it's when you look at these debt funds or mortgage pool funds in the market, of which, like you mentioned, you guys have, 4 of them of different flavors, based upon, sort of these different loan types. It really is important to understand who those borrowers are, the nature of the loans, the purpose of the loans. Because to your point, I mean, that's the big difference. If there's a mortgage pool fund with a bunch of purchase money loans with borrowers with 750, 760, 780 credit, on, purchase money. So then they're going to occupy this thing. That's a lot different than maybe the guy with the rehab guy who's not owner occupied, who's repositioning this asset for a fix and flip or whatever. Those are the ones that some of those guys, the project goes sideways. The likelihood of them, I should say, the likelihood of that guy walking away from the house is much, much higher than the likelihood of the person who just bought this other house. Right.
It's funny that a primary residence used to be the favored asset to lend on for hard money lenders, in the 80s and 90s and early 2000s for that very reason. Well, that's the last home they'll walk away from. That changed after the market correction or crash, whatever you want to call it, in 2008, because so many consumers abandoned their homes. And so as a result, I remember my individual note investors back in 2009, 10, 11 telling me, I'll invest in anything but a primary residence, no primary residences. And then Dodd-Frank made it, virtually illegal for many of them to do that without the extra licensing. But I think that's turned the corner now. I think
a lot of those people they had very little or nothing into it. So they didn't have any skin in the game, which now, once again, Dodd-Frank, you can't do that. They do. And then, of course, that was the issue, is that then even if they had whatever 3% or 2% or whatever they had into it, property values dropped. in California, in certain places, maybe 25, 30%. I mean, like, they dropped a lot in certain places. So then there was no motivation to do so. In the market we're in right now, we have different dynamics. And I think that's what's important, right, for everyone to understand, is that there's not enough houses. One, that's a problem. There's a supply and demand issue, right? The credit requirements are much higher, and the down payment requirements are higher. So, but these are the things, that's just it. Like, context matters. So, and this is when you're an investor, like, these are the questions you have to be asking. Right? It's like, great, the fund spitting out a 7%, annualized return with a monthly distribution. I mean, that's great. I mean, like, that's a good thing. But the question is, what kind of risk is being taken in the portfolio? You sort of need to ascertain that to figure out, is that 7% return I'm being compensated a good risk adjusted return or not? If it's 7% on a bunch of, construction loans only, hence why you guys have a separate fund for that. The construction lending fund has higher returns. Well, why? Because it's a bit riskier than purchase money loans, or, right? I mean, like, that's the thing I think people don't, hence why you guys have multiple offerings, is for that reason, is because everyone's got different risk tolerance.
Right? Exactly. And as an investor today, I would be concerned that lumber prices are going up, concrete prices are going up, all of the subcontractors are raising their prices. So if you're investing in a fund that has a preponderance of fix and flip loans, you want to be careful, because I know personally a number of real estate investors and developers, flippers, and contractors right now who are looking at not making any profit on projects in process because of what's happened with labor and materials. So it's it's something that you need to be careful with when you're investing your capital in a mortgage-backed fund. Now, overall, I still think mortgage-backed funds provide some of the best opportunities to create reliable monthly income. But as I know talk on your show quite a bit, you need to investigate the sponsor. Do they have, is there more than one manager? How big's their company? How big's their team? Do they use third-party fund administration like Verivest? Do they audit their funds annually? Or is it just a one-man show? You really want to look at things like that. Who's minding the bank? Who's minding the money and making the decisions? These are all things that are, very, very important. And so I appreciate, what you've done at Verivest with creating a process where, you do due diligence on your clients, whether or not they're using Verivest for fund administration or not. You have a way of evaluating that. You do background checks, and these are all good things. This is a service to the investment community that I would hope that they would appreciate, because it's needed and it's valuable, and it's something that people should pay attention to.
There's no doubt. And I think that that's what, for a couple things that I've always admired about you and your ability to sort of cross the chasm and make the shift to funds, right, was twofold. One was, you and Edward and your weekly, radio show, which, was happened and existed before then. You continue to do this, and you guys are out educating the market. You're talking about these sorts of topics, financial topics, investing, it's not Pacific Private Money, all day, every day on the radio show. It's about topics that matter, right? And you're informing and you're educating. And I tell a lot of my clients, I'm like, you need some kind of thought leadership platform. For me, it's this podcast, or it was the webinars that we used to do a lot of, or whatever. But I mean, that education component. And, my belief is that if you're an investor looking at someone, I mean, the expectation should be that they're doing something like that. They're offering this education. They're demonstrating their competence by educating. One, when you teach people things, you learn it better yourself. I mean, I've always said that, like, if you have to teach it, it just forces you to really internalize, and you just become better at it yourself. You guys have done that. The other thing that I tell a lot of my clients and use the examples, that from day one, you realize the value and importance of outsourcing the fund administration, because for you, that allowed you to give your investors or prospective investors that additional peace of mind that says, hey, all the money is going in and it's being accounted for by someone not named me or any employee of Pacific by the money.
Yep.
And they make sure that the loans we're making are actual loans, and you use that and you leveraged that point to instill that confidence, what I now call shortcut the time to trust. Hey, I met you, you heard my radio show or whatever, and I helped you learn these things. And then you came in and I said, I've got investment opportunity for you, but I've mitigated the risk of me running off with the money by hiring somebody else to make sure that that's off the table. Right.
Absolutely.
And I tell people, I'm like, Mark, started and boom, grew. I mean, you're our success story. You're the one that been with us from day one, super successful, launched multiple funds, have found a way to finance and fund your deal flow, expanded product lines. Those things start with who people are in their core, right? Their philosophy, their beliefs, what they're made of, right? And those are the things that, the investors need to look for, right? They need to be asking those questions. Because to me, that's where it is about risk, is that my belief is that if, fund A is paying 7 and has everything we just talked about in place, and fund B and more or less has the same portfolio, and fund B is paying 7 and doesn't, you're not being compensated for the risk, because there's a really good chance that the loans could be phony, literally not perfected. They don't have they're just made up. How would you know? You wouldn't know, right? Like, you're the lender. If there's no leverage, like, hey, there's no leverage on this. Well, no leverage also equals there's no one else who really cares about whether or not these loans are real or not, right? Like you as a limited partner or the member are the one who needs to care, and there's an auditor or whatever, obviously they care, but, and then you don't know if the money's going where it should go or not. So the risk premium that you need to be compensated to account for that is way more than, the 7% return that you're being offered. And I think that that's what's important for people to realize, is that risk, when those things and controls aren't in place, is too high, right? And it's so high, in fact, that you have to walk away, because it doesn't work then. Because what if it happens? What if it turns out to be where they're just making it all up? Then you go to zero. Yeah. Right. You go to nothing. You lose your principal. To your point, you guys are making loans and haven't lost a dime of principal on the loans, right? Let alone investors losing principal, right? Or even missing the return. Like you're delivering the return. So
exactly. Well, you bring up a good point in that, the real estate related funds syndication model and industry is fairly mature. In 2013, one of the things that happened was the Jobs Act that made it legal for the first time in 70 or 90 years to advertise these private placements. And that's really when the growth of these funds and the creation of these funds really took off. But, now in 2021, there's really nothing new and novel about fund creation and fund management. And so, what you're doing with your company is you're saying, look, there are best practices here among fund creation, fund waterfalls, and fund management. Things like annual audits, things like a best practice of using third-party fund administration. What kind of expenses do you actually run through your fund, or does the sponsor pay for most of that? These are all things that are really important. Are they using leverage? And if so, how much leverage? And if they're using leverage, you better be making a higher return than an unleveraged fund. So there's just a lot of things that your site and your company is out there providing, open book information about how funds should be run and what kind of returns you should expect to receive, whether it's a debt fund like the funds we do, or if it's a real estate development fund or a land fund or other real estate related funds. There's best practices and there's commonalities between them. And if someone is operating a fund that's outside those, then you might be best to steer clear of that.
No, most definitely. Yeah. And that's what I say, like, there's no, you have to educate yourself, right? Like investors, I mean, this isn't that's what I mean. Like even when things on the surface look to be the same, they more often than not aren't. Right. And I know that and you and I have had this conversation dozens of times. It's just, people are attracted to the shiny object and the returns. And it's like, I understand it, but it's one data point. 9% return, 10% return, whatever it is. It's just one data point. And all it tells me is, how did they generate and how much risk did they have to take, or are they taking to generate that return, right? That's net to me. And it just, you have to read the documents. You have to understand the strategy. You need to look at the list of assets, the loan tape, the schedule of real estate. I know that some of those things might be things that you're uncomfortable with or don't have those skills yet, but if you're going to be an investor and you want to be in a position to generate 7, 8, 9, 10, 11, 12% returns on your money, right? Instead of in a CD or some T-bill at, 1 or what, I don't even know, whatever they're giving you. Not much, right? It's just like, that's the whole point. The way in order to generate that return requires a little bit of effort. Now, you might be in a passive capacity or a limited, partner capacity, but it doesn't mean that you get to check your brain at the door, right? I mean, like, it is investing after all, and will require you to dig in and ask some questions and sort of figure it out. And that's the stuff that drives me crazy. It's just because it's like, I don't want to hear it. You're comparing, you're asking me, to say, what about this one versus that one, as though they're, both apples or bananas. And I'm going, well, I hate to tell you this, but that one is an apple and that one's a banana, right? Apples, oranges, bananas. They're different things. You're not comparing similar things.
Right.
And so that's I think that's been the hard part, because now even on, Verivest.com as we speak, I mean, there's, probably over half the offerings are debt funds, which is great, because debt funds are great. They usually provide a monthly or quarterly, distribution and whatever, but they're not all the same thing, right? They're all have nuance and differences. And it's important to understand what those are before you assess and judge them, or certainly before you decide to allocate capital to them.
No, absolutely. I mean, we've been really blessed overall in the economy the last few years. I mean, whether you've invested in stocks or syndications or cryptocurrencies, you've probably done pretty well if you've taken chances. But going forward, that's always the thing. I mean, for me, I get questions all the time. Where do you see the real estate market heading? Where do you see, interest rates and mortgage rates heading? Where do you see the risk in the types of funds that you're offering? It's the same type of question that we ask ourselves for those of us who invest in the stock market. Is the stock market, top heavy? Are cryptocurrencies top heavy? When's going to be the next stutter step? These are all things that we're constantly, evaluating, and it's an ongoing process. There's a lot of capital out there, a lot of people with capital, a lot of people have done well with capital. They've done well with real estate investments. Some folks have taken money off out of the stock market or out of cryptocurrencies, or sold real estate, looking to potentially park that money, but still get a yield. And where are, again, I wouldn't call what we do a safe haven, because I think I would reserve that for more traditional, T-bill and CD type of investments, insured investments. But that being said, there are several real estate debt funds, including a couple of the ones that I think that we do, that you can get a healthy above market return, 6-7%, with very little market risk based on the type of loans they're doing. And these are the things that I think, are worth investigating for your listeners.
Yeah, and I agree. And that's why I think the assessment's done, is just saying, okay, what's the construction of this, right? So it's like, is there leverage? Yes or no? If so, how much? Right? Because it does. Like, if they've got a specialty lender that's advancing 50, 60, 70 cents in the dollar in first position on those loans.
Yeah.
Well, if something happens, those guys are standing in line saying, pay me first, and it's ahead of you. Right. And so, yeah, it may be juicing the yield to a 10 or 11 or whatever it is. I mean, hey, that's better than a stick in the eye. But once again, you need to say, hey, great, to generate the 10 or the 11, they had to borrow at, 4% or whatever in senior position. And then, I mean, let's face it, we've been on this. I mean, we went deep in the deep freeze and then we've crawled ourselves out. And so it's 10 years. I mean, what goes up must come down. It is cyclical. It will cycle.
Yes.
And we have to just, as you said, the whole global financial crisis, or the crash of the market, it wasn't a crash. It was like a slow motion crash into the side of the mountain. I mean, it was, you saw it come, it was there. Yeah. I mean, the crash was the day that like the banks that were, that held all those things, just, Lehman Brothers on.
Right. The stock market crashed, but the real estate prices, it was a prolonged downturn over a 3-year period where, in our markets in the California Bay Area, we did see as much as a 50% decline in valuation. So, but you're right. It wasn't a crash, but there will be another declination. We don't know when and where and what's going to trigger it, whether there'll be a black swan event or whether it's just going to be, buyer fatigue and affordability issues that will drive real estate prices back down. But you can pretty much count on there being another cycle in the coming years. We just don't know when it's going to hit.
It's going to be, but we know we're closer to it today than we were yesterday. And
that's true.
And I think that's why it's important to understand that should something like that occur, that you just, it's not to say it's bad. It's why I tell people, like, I'm not a leverage is the devil guy. I'm just saying that I've been around and I've experienced firsthand bad things that happen when you use leverage in a debt fund in particular, right? No matter how great the underlying assets are, if the capital structure goes sideways on you and the markets freeze up, like it's just, it can be bad for the one who's subordinated to whatever that thing is.
Yeah.
That you're not getting any return on it. So it's just that's where it's a personal thing. You have to say, what is my risk tolerance? Right? What is my risk tolerance? What is it that I need? Do I need income? And if I need it, how much do I need to count on it? Because I hear, I talk to lots of multifamily syndicators. One of the benefits of investing equity into multifamily projects is that there's oftentimes cash flow or distributions. But as we saw with the hiccup last year, some of those things get suspended really quick, right? Because, and it makes sense because they're sitting there going, we can't be sending distributions out of this property if we're going to experience significant vacancies or whatever. They got to hold on to the cash. And so it's just, I know it's great that it produces income, right? But it's that can you count on that income more than you could count on income from like a mortgage pool fund that has a diversified exposure to 70, 50, 150 loans? That's the assessment, right? Like, and the answer is easy. The answer is a diversified portfolio of trust deeds that has, like that things that the chances of it continuing to, kick out a distribution on the rhythm, monthly, quarterly, whatever it is higher than that multifamily syndication, and so those are the things that you really have to think through as an investor, and it's your portfolio and, are you overweighted or whatever? Only you can make those determinations, but you need to understand the differences between these various offerings that are in the market. It's just, that's called investing. And
there's a smart use of leverage, and there's leverage that maybe you should think twice about when you're looking at investments. And there are funds that maybe they use 20% leverage, but then there's other funds that are as much as 75% leverage. I mean, it's across the scale. I mean, right now in our 4 funds, we don't have any leverage. Although a couple of our funds, we've reserved the right to use leverage down the road if we decide it's prudent, but right now it's just, it's not necessary for us because we're able to raise capital effectively. And because of the resale market, because of the institutional buyers out there that would like to buy our closed loans, that has actually for us negated the need for having for having leverage on our fund, for having a warehouse line, because now we can just simply sell to create liquidity. So it's really the marketplace of institutional buyers has really negated the need in greater part for the use of leverage in a mortgage pool fund.
Yeah, that's right. Well, good stuff. Yeah. I mean, I always love catching up with you. These are really important topics, right? And things to really think through. And you guys have, built a great business over there and been thoughtful about how to serve obviously your borrowers, how do you solve their needs, but also how do you then parlay that into creating investment products
Yeah.
that are accessible by, the high net worth investors, right? To solve problems in their portfolio. Once again, depending whatever your risk tolerance may be,
Right.
how you can get access to those things. So we were just talking about, you guys, the other day, someone was talking about Freedom Fund and the ability to sort of, they were saying to me, like, it would be great, Lance, is if you could have it where when I have these syndication investments that kick me distributions, I want to turn around and invest smaller dollar amounts into like Hanf's Freedom Fund, right? To like, and add the balance. And I'm like, I hear you, man. Like that's where we're headed. And we want to be able to do things like that where, hey, you pay the minimum to get into Freedom Fund.
Yeah.
Got some spare change, I'm sure.
But I'm not supposed to say you can treat it like a money market account because
no, you can't.
But you can treat it like it. It's not a money market account, but you can certainly treat it like a money market account. And that's the new and novel nature of having something like our so-called Freedom Fund, is just the ability for people to park money for short periods, knowing they're not going to be penalized if they need it right away.
Yeah, but it's, once again, it's meeting a need in the market. It's sort of that, hey, I've got money, the ability to have some, because of the high velocity. Once again, you look at the underlying assets, is that you guys are using it as warehouse. So meaning it has high velocity of assets hit, they're
2 to 3
there,
times a month.
Boom, and they're gone.
Yeah.
So when you look at that sort of it matches up. I mean, if that was 3-year paper, whatever. I mean, the point is that those are the things that make it work, but that's, it's an innovation and it's interesting. But those are the things that, we're trying to do, is realize the same, is that, investors are going to want to diversify across sponsors. Of course they do. Their portfolio has other needs. They want geographic diversification, sponsor diversification.
Yep.
How do we make that easier for them to, allocate capital and build and manage and maintain those portfolios more intelligently, is the stuff that we're doing, at Verivest. So good stuff. So where can people learn more about you guys at Pacific Private Money?
So our website is pacificprivatemoney.com. That's the easiest way. And we're in the Bay Area at the 415, our phone number, if you care to call, and we answer our phones all the time live, 415-883-2150. And we talk to investors and borrowers every day, and we welcome your call.
Cool. All right. Well, that's episode 100, folks. So here's to another 100. Mark, thank you so much.
Absolutely. Thank you, Lance.
Ongoing support. It's been a pleasure, man. And it'll be, we'll do another 100 episodes in another 10 years and just keep this thing rolling.
Good.
All right, man. Take care.
Thank you.